Good morning, hello and welcome to Opening Bell. You're with us on Moneycontrol. I'm Surabhi Upadhyay. It's a Friday morning and the market is still continuing to watch all the headlines coming in from Iran and from West Asia. There's been unfortunately no positive news to report, and markets are trying to sort of wrap their head around what's happened overnight. I want to start first by looking at the screen. So let's take a look at what's happened with the oil prices and with the Asian markets. There's a fair amount of caution because oil, as we speak to you this Friday morning, is still very much around $100 a barrel. That fact is not changing. That's what we have. Let's look at what's happened with the dollar index. The fact that there is a risk of continuing in the market has meant that the dollar remains well bid. There you see 99.74. Even the dollar index is pushing closer towards the 100 mark, and there's some buying that we can see visible in gold as well. US markets ended down and down quite a bit, 1.5% to about 2%. And futures are again pointing towards a bit of a cautious start. Asian markets largely are lower. That's the picture that we had, on Wall Street last night. Key indices were down between 1.5% to 2%. The Russell 2000 fell the most. And most Asian markets are suggesting that we will have another cautious day. Most of them are trading lower, and the GIFT Nifty is suggesting that we will probably start another 100 points lower. So here's where the geopolitics stands. I just want to quickly run through some of the announcements that we've seen because it's all about tracking geopolitical developments. Now, Iran's Supreme Leader has said that the Strait of Hormuz should stay closed. That's the only way of putting pressure, quote unquote, on the enemy. The new Supreme Leader said that newer fronts can be opened if the war persists. On top of this, you've got a US military refueling aircraft which crashed over Iraq. We don't know more details in terms of casualties. One landed safely, one has gone down. The US CENTCOM has said that this was neither due to friendly fire nor due to hostile fire. No other details have been given. In the meantime, the US has said that countries can buy Russian oil, all countries. First, they gave that window to India. Now it's open to all countries. Whatever Russian barrels are right now out on the sea already in order to calm down oil prices. Inflation is the big talk point in the US as well. The January PCE numbers will come out today. And in India as well, inflation is the talking point because the CPI numbers have started inching higher. This is, of course, well before the implications of oil at 100 can be priced in. CPI inflation data that came in yesterday told us that February inflation, consumer level inflation, has come up to now 3.2% versus 2.75% month on month. Food inflation is also slightly increasing, 3.47%, though core inflation is unchanged. Now, what next for our market? FIIs are constantly selling. Even yesterday, we had a big sell figure, about 7,050 crore rupees. Domestic institutions were offsetting a lot of that with the constant buying, but the market has been grinding lower. And that is a reality that sort of we can't wish away. It is the reality on the screen. So what next and how should you look at Friday's trading session? We've got Raja Venkatraman joining in, co-founder at Neo Trader. And we have Mayuresh Joshi joining in from MarketSmith India. Thank you very much, gentlemen, for being with us. Apologies, little delay, some technical issues there. But Mayuresh, let me come to you. The week has come to an end. And like I said, those headlines are anything but comforting. Oil at 100. Do you think the market at some point will see a relief rally, a relief bounce? I mean, for those who've been looking at opportunities to buy in, are you saying that, that gradual deployment of money should continue? Or do you think this is still looking very, very volatile and confusing?
Morning, Surabhi. No, again, I think a lot of mixed news coming in from the Middle East, which obviously is not very comforting for equity markets. And therefore, I think our approach has been a wait and watch. You probably need to still wait it out. There is no need to rush into these markets into a very aggressive mode because every day, I think the rhetoric is probably changing. And one really does not know on ground what is actually happening. And therefore, I think that uncertainty phase and periodicity, which might linger longer, creates that kind of an overhang for the markets. So our sense is just wait it out a little bit more, see what kind of news flows is happening on the macro front, what happens with Brent as a corollary to that, and therefore be very, very selective. So at this juncture, I think start creating a watch list in certain key sectors where earnings might hold up, assuming that the war probably elongates. And then with that aspect, I think once we get some element of clarity over the next few days or weeks, we can then start probably getting into the market in a piecemeal.
Okay, all right. Got that point. Coming to Raja, coming to you. I mean, I don't know what levels are sacrosanct. We've already lost 24,000, and the market is practically at a one-year low, Raja. What's the advice?
Yeah, if you're going to talk about the levels, good morning, Surabhi, and good morning to all. So, first of all, when you're talking about the levels have actually lost any meaning in the current juncture because right now the war is dictating the entire flow of events. So, in such a scenario, it's best to actually not look at levels, actually look at the news flow because there are times when you should be looking at news flow and the levels, but this time I feel that news flows are having a higher precedence and higher impact. So yes, we can keep on defining levels, but there seems to be no end to the geopolitical news flow, and every day we are having a different picture that has been painted. What's the repercussions on the Indian markets continue to be on the negative side, and I think that that could persist. So the first level of support was 23,700, which managed to hold on yesterday. Now it is 23,500, and based on what the GIFT Nifty is showing, we are expected to open below that. Now, once 23,500 opens, then there is a lot of room available right up till 23,000. So yes, the scenario is not good. And well, there are a lot of sayers out there who are calling for bottom fishing. But I would say that one should be cautious here as we are also getting into an oversold position. So probably the fall which we could see, and also with the weekend coming in play, I would see that after I would wait at least for the first 30 minutes of the day to see what kind of action takes place at 23,500 and then take a call on the downside. Otherwise, I would wait my time out because I see that 23,500 is a very important support based on other set of evidences.
Okay. So that's as far as the Nifty and the levels are concerned. Mayuresh, in terms of stocks and sectors, and I'm sort of asking for a more holistic view now, a lot of stocks in the oil and gas space that have been completely whipsawed this week. And this whole concern around gas shortages and what happens. Just give us advice on the oil marketing companies and on the gas stocks and even the upstream companies. Whether we should keep anything in the portfolio, stay completely away. What would your sense be on oil and gas?
It's too volatile. I think, take an instance, Brent crude itself, right? I think it jumped to 110, 115. It retraced back in a day's time close to that 89, 90 levels. It's up again on that $100 mark. And it's very, very difficult to be in a scenario to probably then assume where the direction of oil will be from an immediate short-term perspective. Obviously, we are reading reports that if you probably look at the forward contracts, the 9 months down the line, they're trading at a discount of $40 to $45. But one really doesn't know at the current juncture on how these movements will probably shape up and take place. And therefore, I think to take a call at 110, whether oil will reach 150 upstream would have probably jumped up, or would have corrected the moment I think oil slipped back to 90, again above 100. So I think upstream might again remain in focus. But I think it's very difficult to monitor these day-to-day moves. For downstream, again, I think what probably happens with oil prices now elevated from the base levels that we've seen at 70, 75, clearly might mean what kind of initiatives the government will take, how much of the absorption will these oil marketing companies take on their balance sheet without passing any prices, if any, and if this sustains over a longer periodicity of time, and therefore have an impact in terms of the reported numbers, partially in Q4, and if this extends into Q1 as well. For gas companies, I think the shortage clearly affects their overall business momentum, both in terms of utilization levels of their existing assets, and what probably goes through in terms of transmission revenues and transmission incomes as well. Again, priority lending is something that the government has embarked upon, but if there is an overall shortage in terms of volume of gas, it really becomes a little bit of a circumspect aspect in terms of reported numbers. So I think, again, a space where I think there is a lot of volatile and dynamic news flow. So I think staying away from the entire sector as we speak at this juncture.
Okay, staying away from the entire sector. Let me talk about something very different that has nothing to do with the war. And I'm talking about the NSE IPO, gentlemen. Now, I don't know. I mean, it's too early to start talking about what's on offer, and we'll get those details gradually. But the whole army of, I think, merchant bankers and legal eagles are bringing the IPO to market finally, long awaited. Mayuresh, it might just get the capital market space excited again, right? How are you reading through the progress and the implications? And within the capital market space, there are existing exchanges. Do you think that there could be some sort of a re-rating as the NSE buzz builds up?
No, so I think it's very much on track, Surabhi. So I think whoever I've been speaking to as far as the NSE IPO is concerned seem to suggest that it's progressing well. Having said that, the capital market theme obviously remains a structural theme. Obviously, there have been a slew of regulatory changes over the last few weeks and last couple of months, which has made a few investors circumspect, whether volumes will start shrinking, whether the commissions for all the entities associated with the capital market participants, whether their commission and brokerage income start dwindling lower. And therefore, I think as a theme, structurally, we remain positive. But within the theme itself, our own sense is that asset management companies and wealth managers should be relatively better off for two counts. One, I think the expectations in terms of the number of households above a certain income level are expected to go higher, which will abet wealth managers in the country. You've seen a lot of them mushroom over the last few months, but I think the expectation is that these households might actually double over the next 3 to 4 years, giving ample space for wealth management as a space in general. And for asset management companies, I think the expectation is that the inflows into equities will continue over a longer periodicity of time. They have got their business model now completely set up in terms of the cost structure itself. And therefore, I think as more income and business starts coming in, the costs will not go significantly higher, giving them that leverage on the P&L and the balance sheet that is required. So within the space, Surabhi, I think wealth managers and asset management companies better placed as a capital market.
Okay, all right, got that. Gentlemen, the pre-open rates have started coming in. So let's look at this, and then I want to get to Raja on some specific trades and some specific stocks as well in terms of what to do. So the first hint is about a 200 250 points sort of a drop. Let's see how this settles. Right now it looks a little much. You've got Bharti Airtel down 5%, a little unlikely. So let's wait for some of these rates to settle. 170 points down now on the Nifty. That's a little more like it. A lot of the financials are weak. HDFC Bank, for instance, Axis Bank, again weak. Raja and actually, Mayuresh, this is the other big part of the market. I want to talk to both of you about it. The way financial stocks and bank stocks have sold off, both banks and large NBFCs, this would make even portfolio investors a little uncomfortable. Those who've been holding these stocks in the portfolio, they'll wonder what's going on. So Raja, first to you, what have you made of the weakness in the BFSI space? And do you have any trades here? Any suggestions on banks or non-banks?
Yeah, first of all, when you take a look at the banking sector itself, over the last almost 6 months, the bank Nifty has been performing much better compared to any other indices. And they have been managing to hold the entire act together. So what has really happened is that with the war and the attack on Dubai, and so basically the financial industry has got severely hit. And along with that, the war impact, the combined effect has created a very strong reaction on the indices and especially on the Bank Nifty. Bank Nifty was the most resolute indices amongst all of them. And the way the Bank Nifty has cracked, it's clearly evident that there is more selling pressure on the downside. And even in the Bank Nifty, if you say the PSU banks have been performing better compared to any other associated indices, the private banks or even the NBFCs. So now what has happened is that with the consistent selling at every possibility and also the gap down openings which we are seeing, I think the selling pressure will continue to build. And I see that if you're going to talk about the levels, then the support levels are emerging closer towards 53,000. And I feel that the kind of selling pressure that is prevalent here, the private banks have not been performing. The Q3 numbers were not exciting, and the markets also responded to the same. And the selling actually started off first in the private banks. Now, even if you see when a recovery happens, the first recovery happens in the PSU banks. So overall, the bias is very clearly divided and it's clearly visible. So now, if you want to take a look at the downside, the NBFCs have started performing even more worse. And I would say that stocks like Cholafin or even Bajaj Finance, Bajaj Finserv, so these stocks have also started cracking up because it's very clearly evident that the next quarter two is going to face the pressure, and all this is going to have some severe impact on the market recovery.
Okay, so that's Raja's take. I want to ask you as well, Bearish. A lot of people holding these large bank stocks, HDFC Bank, or even NBFCs like Bajaj Finance, right? Because most have fallen. They would be wondering, I mean, this collateral damage seems to be spreading. What would you say to, I mean, look at this, just Bajaj Finance in just the last couple of days, 10 odd days, down about 15-16%. What would you say to people who are investors in these stocks? And also, what would you buy, if anything, banks or NBFCs? What would you buy afresh since the market is giving that opportunity?
Surabhi, again, I think this is a periodicity of pain that the market is probably going through. I think the BFSI space in general and the larger banks are correcting for two broad reasons. One, I think if again this entire episode on the geopolitical front elongates and continues, there is a fear of inflation coming back very, very sharply across the globe. And if that probably plays out in terms of our base case scenario of inflation, I think the interest rate cut scenario is absolutely out of the window. In fact, if inflation hardens or there is a case of stagflation across the globe, there might be a case of rate hikes happening across the globe. And what will India react to that? I think that's the primary reason why the BFSI space is reacting the way it is. But I think it's too premature, in the first place, to assume all these things. If you have to absolutely have some element of a de-escalation or a resolution over the next few weeks, I think that argument gets thrown out of the window. Second, I think in terms of reported numbers so far, they have been pretty resilient for most banks in all parameters, whether it's advances growth, deposit growth has been reasonable as well. The credit deposit ratios, the expectations in terms of risk-weighted assets, NIMs have remained stable, CASA deterioration largely behind us, makes us believe that long-term investors should stay put in qualitative leadership stocks within the BFSI space. As things resolve, my own sense is that first half, the recovery should be pretty reasonable. For large banks, I think the second other sticky issue will be deposit growth. And how the entire scenario plays out is to be seen. So, as a choice, I think public sector banks are a tad bit better placed. His state bank probably corrects and creates a good base at lower level. Rating rankings look fine. So, I think this is one within the larger leadership bank that I would keep a watch out for.
Bearish, Max Financial, any specific take? They're raising a large amount of money, 2,000 crores via a QIP. I'm not sure if you cover that stock or if you've had a look at it. Any thoughts?
So I think that's a huge raise, and I think how that gets implemented and how that gets reflected in terms of the balance sheet is something to be seen. Obviously, with this raise, I think the expectations in terms of how the business outlook will be over the next few years, specifically, I think the second half of the next financial year, I think that should be a very big supportive argument in terms of their balance sheet growth, and therefore I think how the EPS exit number will probably look as we end FY28. So step in the right direction. The market is probably taking its stride, looking at all the conditions put together on how BFS as a space is moving. But yes, I think it will have a positive impact as we exit FY28.
Okay, all right, got that. Now we're almost at 7 minutes past 9 o'clock. Good time to get today's trades. The pre-open session is also settled, and let's see what it's telling us now. About 150 points down on the Nifty. That's where the large cap screen is. Financials are still weak. HDFC Bank, HDFC Life, most of them are down. ICICI Bank, Shriram Finance. There's some weakness on names like Mahindra and Mahindra, on Maruti. So these are also on the red side of the screen. There are not too many stocks on the positive side, actually, I must say, at least in the pre-open. Power Grid, Coal India, these are the only ones that are flashing a little bit of green at this juncture. So that's what we have to watch out for. Raja, very quickly, your trades today, index or stocks in this confusing market?
Yeah, definitely. So first of all, best to go in the market with a buy and a sell approach. So First of all, I would like to take a buy stock on the power grid because overall we saw yesterday that the power sector was performing quite well, and I would say that power grid has been performing quite well. And over the last 1 month, the stock has been consolidating and it's just showing some promise to move at higher levels. So I would be a buyer in power grid at current levels. Have a stop at around 294 for a target towards 305 purely as an intraday play.
Okay, all right, Raja, got it. Thank you very much for joining us. Yeah, sorry, you were saying?
No, that's all. Thank you.
Okay, and Nifty levels, Raja, before we thank you, just finally, Nifty levels, the final supports, if there are any in mind, and should one try a long trade at all, even intraday?
Yeah, even if you want to try and long trade intraday, wait for the first 30 minutes of the day, and once the range is exceeded, then that would be a good play for 100 to 150 points.
Okay.
I see some weekend short covering.
Raja, thank you very much. You have a good Friday.
Yeah, same to you. Bye.
Okay, got it. You're saying wait for the first 30 minutes. Got that. Thank you. Have a good day, and thank you very much for joining us. All right, so that is the market in the pre-open session right now. Let's quickly talk about today's stocks and news. The first one on our radar is Max Financial Services. The board has approved a fundraising worth about 2,000 crore rupees. Now, this is happening via the equity route. They'll be doing a QIP, or they could be looking at other methods as well, but largely it's an equity fundraise. Vascon Engineers has bagged a contract worth about 115, actually it's more like 116 crore rupees. This is for a development project in Ahmedabad, so watch out for Vascon as well. Balaji Amines joins that long list of companies which is facing business disruption due to a lack of gas, just non-availability of gas. They've said that there is a disruption in ammonia procurement due to the West Asia war. Some plants of the company are temporarily non-operational because apart from gas, there's also ammonia shortage. So that's another stock in focus. Kalpataru has signed a redevelopment project in Andheri West in Mumbai. It's the redevelopment of the Sri Mahalakshmi Housing Society, and the gross development value is around 1,400 crore rupees. It's a big project for Kalpataru. Moving on, JK Lakshmi Cement has been declared as the preferred bidder for the mining lease for a limestone block in Assam. So JK Lakshmi is going to be on our list as well. Okay, so that's as far as stocks are concerned. Let's do one thing. Let's quickly leave you with a couple of top brokerages as well. A lot of brokerage notes coming in on financial stocks, on a bunch of others as well, including autos. So check out some of these top broker recommendations this morning, and we'll come back and get a conversation going on the slightly more longer to medium term market technicals. Back with that in just a bit. Check out the broker notes. Okay, those are a couple of brokerage notes in focus today. By the way, our colleagues point out that the currency has hit a fresh low, all-time low this morning, and that's on expected lines like we just checked. The dollar index is almost now nudging towards the 100 mark. Pull up the dollar rupee, 92.32. That's the level right now. So it continues to weaken well past 92. Let's get both the dollar rupee and the dollar index itself up on the screen. The pre-open is settled with a cut of about 170 odd points. Rohit Srivastava, founder of India Charts, joins us. He's our next guest on the show. Rohit, good morning. Great to have you back on Money Control. How are you feeling today?
Well, the route just goes on. Nothing has really changed in trend. We also don't have any near-term readings on our sentiment indicators that would tell us that we have reached at least a bottom from where we can bounce back. So we don't even have that. There is only one technical indicator that will turn oversold, which is the RSI, which is more popularly watched. But we look at a bunch of sentiment readings, none of which have really gotten there. So what we are really looking at is a market that is in free fall. The reason for that being, purely on charts, we broke a level at 24,600, which we call it a neckline of a head and shoulders topping pattern. And a neckline is essentially a line that touches several bottoms that we made previous to that, like when we sold off in July, when the trade deal had fallen off, or when we sold off again in January. When we touched those bottoms, that was at 24,600. Yeah. So breaking that sets the stage, for this sell-off that we are really seeing. And has it spread to other indices? That is the next thing. The Nifty 500 broke a similar level just 2 days ago. And lastly, the midcap index is on the neckline and still not broken, so we're just there. Yeah.
Yeah. Rohit, I'm sorry, I'm interrupting because the market has opened and look at it. I mean, it's a clear gap down once again. I'm just going to come back for you to finish that point, and you're making a very important point to understand the longer term technical nature of this market. But look at today's opening as well. I mean, it's just continuing. It's kind of a one-way decline. It's, as they say, the proverbial is a big cliched statement, but it is a falling knife. And no one's willing to catch it for obvious reasons right now, and maybe for good measure right now. 178 down, that's how this day starts off. Let's take a look at the Nifty. An overwhelming majority, almost I think 45 out of the Nifty 50 are negative as we start off trade today. At some point the buyers will come in, and let's see when that happens and when sentiment turns. But right now Mahindra & Mahindra, HDFC Bank, L&T, Ultratech Cement, Tata Steel, Infosys, HCL Tech, it doesn't matter, right? Sectors don't matter. Bajaj Auto, Eicher Motors, HDFC Life. So financials are down, IT is down. L&T is again falling quite a bit. Of course, its direct exposure has hurt it quite a lot. And yesterday, one of the big brokers came out with a lower price target on L&T as well. It's down about 2% as we speak. What else? We can see more names on the way down. Tata Consumer, Grasim, BEL, Kotak Mahindra Bank. Lots of stocks on your screen. Metal stocks as well, no shine whatsoever. So it's just a complete all fall down kind of a situation. Yeah, all the stocks are on your screens. Okay, we've moved to mid-caps. Before mid-caps, let's talk about the Nifty gainers as well. Not there are many, but the ones that are up, let's point them out. Coal India, Power Grid, Bajaj Finance, NTPC and Eternal. So these are some stocks that are trying to fight this downward draft. And there's a gain, but a gain of about 0.5% to about 1%. It's unrelenting, the pressure on the market, 171, 80 points down. Okay, now I want to move to the mid-cap screen. The mid-cap index, by the way, is kind of in sync with the Nifty. It's down about 0.6%. Nifty is down 0.75%. What do we have on the mid-cap screen? Again, a whole clutch of stocks. Devyani International, City Union Bank, CEAT, Apar Industries, Shakti Pump. Some of the pump stocks got very excited because the Jal Jeevan mission was extended earlier this week, but they're cooling off right now. You can see some IT names there, Memphis, Persistent, lower, Astral lower. It just goes on and on. Quite a list of sort of losers this morning. Bandhan Bank is lower by about 2%. Lemon Tree is falling by about 2%. So the thing is that we don't have like a massive cut in prices, but it's a slow burn. It's a slow grind down. That's what the market is giving us today. Let's see if there are any mid-cap gainers worth noting. A bunch of PSU stocks actually. So there is NHPC, there's Power Grid, there's SJVN, Coal India. Relatively speaking, GAIL, BHEL, relatively speaking, There's a little bit of green here and there on PSU names, but otherwise not too many gainers to spot this Friday morning. That's how it's stacking up. Adani Power, NTPC Green Energy, Adani Total Gas. These are some of the other names which are managing some gains. And of course, TTK Prestige with all the induction cooktops flying off the shelves. TTK is still up, as is Stovecraft. These are the two really stocks of the week on the way up. That's the market for now. Well, in a bit, I think we'll have Ajay Khandelwal also join in. Let's go back to Rohit, who's explaining the technical nature of this fall. And Rohit, I want to go back, to our conversation on Budget Day, which I remember very clearly. On Budget Day, 1st of February, there was no war, there was nothing. In fact, if anything, immediately after we had the trade deal issue get resolved, we had a deal with the US. But I remember you were very bearish on Budget Day itself. I remember that conversation, and you said that this market is looking extremely tentative. So, hats off to you for reading it right well before the actual event happened. But go on, you were explaining, and I want to tell our viewers what Rohit is talking about. This head and shoulders pattern is a very important pattern in technical analysis. And that neckline that he's explaining got breached, just a couple of days back in this fall. So, Rohit, go on. Tell us where we are standing right now, and if any, downside targets. Is there a downside trade? That's also my question. There could be a bearish trade, right?
Yeah.
There are people who are willing to take that trade. So what about that one then?
Yeah, so the bearish trade actually continues. So I was mentioning 24,600, which the Nifty really broke quite some time back. The Nifty 500 a few days ago, and the Nifty midcap is sitting on that line. So it is just in the process of maybe breaking. So we'll have to see today whether if the Nifty midcap index closes down by, I think, more than 0.5%, we would probably be below that line. Now, the implications of that in terms of Nifty are what the theoretical projection is that you can go down to around 22,600. So that still leaves open close to an 8 to 10% kind of downside as far as the main index is concerned. And this happening simultaneously with the RSI, a very basic technical indicator, getting slightly oversold, puts you in a tricky spot that, it's oversold. You really take a short trade here. But on the other hand, if you've already taken short trades, there's no reason to exit them, but simply trail your stop losses and, hold on because you haven't reached the end goal. And many times what really happens when, you have a free falling knife is prices continue to slide even in oversold territory. And that is, I think, the kind of setup we are seeing. We are also seeing something similar start to, develop in the US, the RSI indicator for the S&P now closer to 30. It's just getting there. So it's not gone into oversold yet. But maybe it does. If it falls for one more day, it will probably enter that zone. And all of this on just recognizing that this is going to be a more prolonged affair rather than something which is very, very short term. So we have the breakdown. I think the only time we look at buying is only when near term some sentiment data tells us that yes, everything is gotten too far. But we are not getting a clear read on that yet.
And Rohit, right now, just to reiterate the level, right now, what would be your target of that downside trade, the bearish trade on the index?
So 22,600, that's the number we are looking at. As long as we are below 24,600, we are looking at going down to 22,600. Yeah.
Wow, that's quite a target. So Rohit, feels that in this current bear run, the market could test levels as low as 22,600. We'll keep that in mind. Before we talk more about the Indian market and stocks and sectors here, Rohit, just a read through of the global setup as well. The fact that the dollar index is going to 100, the fact that the rupee is as weak as it is, and even bonds. Bonds in the US, the yields have been rising because of this whole inflation worry. What is the overall global, and then of course US indices, what is the global construct telling you now?
So US indices, equity indices have actually been very slow to react so far. And I think that's because the narrative that has been coming out of the US has been that this is a short war, it is contained, we will soon have control over the entire situation, and we are sort of winning the war. So there has not been much of a reaction because of that narrative. Otherwise, probably, even if you go back to the Russia-Ukraine conflict, the reaction in equity markets, if you measure it by something known as the VIX, including you look at the India VIX and you look at the US VIX, We went to almost over 35, 38, or 45 in the US VIX, I think, when the Iran-Russia, conflict started. So far, we have not even crossed, we barely crossed 22, 24 on the India VIX. So we are actually not seeing it, go up significantly. If we have to even match the Russia conflict, we have to go to 35. So that's one thing that we can, keep in mind when it comes to sentiment. The US dollar, that is one of the reasons why I was sounding, bearish, like on budget days. The US dollar actually bottomed out late in January and has turned up constructively medium to longer term. So we do see the dollar index gaining. We, of course, did not know what reasons would be driving it. Now it's the war. At that time, it could have been, something else. It could be the slowing economic activity and, various data points that you're actually getting out of the US, whether it's job openings, whether it's, inflation data. There has been some slowing. It's not significant. It's not enough to say that it's a recession, but there is some slowing. So that would have been the driver of the dollar if it was not the war. That's what we would have looked at. But in any case, the rising dollar usually creates a risk-off environment, in emerging markets and commodities. We saw that in gold and silver earlier. And if it is accompanied by a rising bond market, then it's a clearer sign of recession. But because of rising oil prices, we've seen bond yields actually turn around and the bond prices start to fall in the last couple of days. So that sort of changed at least that one part, but for very, very different reasons.
Sure. Just stay on, Rohit. We also have Ajay Khandelwal joining the conversation now. So we'll have a fundamental layer to this as well. Can we get Ajay? Yeah, Ajay is there with us on the screen. Ajay, good morning. Thank you very much for being with us. Tough times, huh? So I was just discussing this with Rohit, who tracks technicals so closely, Indian and of course global. And Rohit got bearish on budget day. And it was not because of the budget announcements. He anyway was like, the structure of this market is not looking too great. And now we know why the events follow. But Ajay, 10, 11 days into this war, how are you feeling about the market? And the problem is that, yes, in the long term, everything turns around, everything gets better, and Indian equities will do well. We all know that, and we believe that. The problem for investors is they don't know when to deploy. They've been waiting for 15 to 18 months. And this war has come at a time when we were just hoping that earnings start turning around, the trade deal is done, and now we have this fresh uncertainty. Your thoughts?
Yeah, thanks. So, Surabhi, as you said, we have seen different cycles. And for us, the real concern is inflation. Because when that happens, and especially this time what is happening is that the raw material prices are going up because of supply constraints. Whereas we are not seeing it getting passed through to the end consumer because there is no leeway for that. So it's more like there are certain industries which always has this very difficult equation where your prices are capped, whereas your margins are always hit when there are issues in supply. So take the example of spinning industry, for example. Now, we are seeing that in other industries happening, the same phenomena. Interestingly, see, if I take a cue from the Russia-Ukraine war, there was no Nifty earning cut. It was 25 to 30% kind of earning is adversely impacted because of increase in oil prices, whereas 25% is it gets benefit out of that, and the rest 40-45% has no impact. So there was no earning cut per se, but we know that the second order impact is always there. The consumer buying power goes down. When markets start seeing lower volume growth, it is reflected in stock prices also. And fundamentally, if anyways you increase the risk-free rate, the equity market has to come down. So last 15 months of no price action was not worrying for us because it's okay. FII selling, other markets doing well, it has nothing to do with us. On the ground, businesses were doing okay. We were fine with it fundamentally. Our concern is if this continues, if this drags on, then because of that, we will see actual earning revision, downward revision, and that is more concerning.
Yeah. And that is exactly what I want to discuss with you, Ajay. And we have to go over that in some detail, right? And I want to get to the way you are looking at your funds right now, whether the time has come to take any hard calls, say on oil and gas or other parts of it. Allow me 2-3 minutes just to complete the point on technicals with Rohit. And then we come back to that earnings, big question on earnings now that seems to be arising again. Rohit, you mentioned that you were expecting the downside in the market to continue. Just give us the levels on the dollar index. Where do you see it heading? And within stocks and sectors here in India, is there any hiding space? Before we got into this wall, anyway, IT was getting slammed. Now people are going back to IT a little bit, seeing it as maybe a bit of a safe haven. So I don't know, is IT a safe haven? Should you be in upstream companies like ONGC? And again, this is a question not on an intraday basis, but someone who's looking at this market with a 2-3 month at least horizon. What changes, if any, should he or she make to their trading portfolio?
So I'll start with the dollar index. Initially looking at around 100.35. I think that's the first breakout point. And once we cross that, then we are going to go all the way to 105. So that is the overall picture. Will we go beyond 105 is something we'll consider later on. But right now, 100.35 and then beyond that to 105 is the trend that we are looking at. I do sense that this is not just a short-term move. It is a medium to longer-term uptrend in the dollar index that is developing. And the reasons could keep changing from the war to something else later on. So that's as far as the dollar. So that pressure point remains. Now, where can you find a hiding place? Yeah, there are a couple. I think it's definitely not the IT sector because that's been shaven off from its defensive sector stance. So that's not a sector or area that you even want to touch yet. But where is the defense? It's probably in pharma. Pharma stocks, in fact, even the US policy, if you heard them, recently was that they really need cheap drugs to happen. And that's something which was a positive announcement from the US, which means that our generic producers will continue to get demand for what they supply to the US. So I think generic players, specifically in pharma, would be an interesting place. And you're seeing some of the pharma stocks hold up. If you look at Sun Pharma, for example, it's really not going down with this decline. In fact, it has gone up over the last couple of weeks. So you may find others as well. So outperformance in pharma stocks, wherever you find it, I think that is a good place to hide if you really need to reallocate capital somewhere. Another place which is coming up of interest is in the energy space. Now, of course, energy has already been a bull case earlier. But it makes the case stronger as the oil market gets tight, that renewable energy stocks are finding, some kind of buying interest. And that's why you see the energy index actually positive today. And I'm not talking of oil and gas stocks. See, in the US, the oil and gas index is the one which is outperforming because it's very, very directly linked to the price of oil, which is not true for India. You can't go and buy an HPCL or a BPCL because they get hit when oil prices go up. And so our structure, on oil is very, very different. But I'm talking of energy companies which are in the renewable space that will, develop future power sources. That will again come back as interest in this kind of market. The third will be alternative areas. I do see strength despite, the strong dollar in agro commodities. So you're seeing individual agro prices go up. And within that, an alternate oil is, of course, ethanol. So that points you towards the sugar sector or sugar stocks, especially those which are ethanol, producers. And that could be another place where you could actually find ideas. So these three areas, I think, is where you can sort of get some hiding place in this very, very weak market.
Okay. And Rohit, just specifically, on a stock like L&T, and the reason I'm picking this one out is that this came from nowhere. There will be a lot of people keeping L&T in their long-term portfolios, right? Big bulls on infrastructure and overall the capex cycle. And a lot of those investors have been writing into us as well, saying what to do because, the way it's fallen 15-16%, and if this war continues, it's got direct exposure. So I think this is one big point of concern for a huge number of investors out there.
No, it looks weak. Just to give a disclaimer, we've already given a short trade on L&T to our clients. So having put that out, we're looking at targets much lower than where we are. Sub 3,300 is what we are looking at because of what is going on. So that's the view that we've really taken.
Okay. All right, Rohit, thank you very much. Good conversation today. There's a lot to talk, a lot more to discuss, and we look forward to another interview. Let's see how the market does, and hopefully this weekend will not be fresh negative news, and we'll come back and take fresh guard, and look forward to connecting again with you in the next few days. Thank you for joining. Have a great day.
Thank you. Thank you. Pleasure, Surabhi. Thank you.
All right. Okay, so now let's go back to our conversation with Ajay Khandelwal of Motilal Oswal AMC. Ajay, earnings. Now, I just want to go back and hit that point on the head, which you talked about, because for us, that's the biggest issue, right? We were all looking at finally moving to double-digit earnings growth in FY27. First and foremost, is that looking like it's at risk right now?
See, because of commodities, the swing in earnings is pretty high. We've seen that in 2024, where we actually benefited out of it. And 25 is when it adversely impacted the earning. So given where we are and the kind of volatility that is there, I don't see earning cut. But the quality of earning is equally important, because if because of increase in inflation, financials, for example, any kind of now rate cut looks very difficult. Any kind of question, there will be questions whether even in telecom sector there will be increase in tariff or not. So some of those things which actually were built in estimates for this year, they may see some kind of downgrade. But Nifty as a whole, I don't think there will be earning cut, because just break it up, you see IT sector, there is hardly any expectation built in 4-5%, which I'm sure the sector will be able to deliver. Our interaction suggests that companies are still holding on to their guidance. So the disruption will not be seen in this year. So should be for this year, I don't see earning cut because of all these factors that I spoke about.
Okay, not right now, not factoring in earnings cuts. Got that. So Ajay, let's talk about your portfolios and how they're positioned in terms of sectors. If you could just run us through what some of your biggest holdings would be and what your top overweights would be, and then let's take it from there in terms of whether you're thinking of any change or any churn.
So as a house, we concentrate on certain sectors. Now, commodity cyclicals has never been our strength. Okay, so last 3-6 months, actually market, the way market has behaved, especially say 3-4 sectors which have done well because of increase in the underlying commodity prices. We do not have a representation of those kind of stocks in our portfolio. We, as you said, in long term, everything will do well. But see, for us, the key parameter is how earnings are going to play out in near to midterm, and whether there's enough tailwinds in the sector, the runway for growth is there or not. So we have stayed away from commodity cyclicals. We are still, and so just to give you a sense on portfolio construction, we are like 45% invested in manufacturing, 50 to 55% services. And recently, we have increased our allocation to more domestic names. So financials, both lenders, non-lenders, is what we have added to our portfolio. And in consumption also, we have added selectively. So yeah, that is how our portfolios are placed. I would say balanced on both sides. But we have stayed away from commodities so far, yeah.
Got it. Okay, so you've not been with commodities. I mean, of course, some of the commodities, including, of course, metals, have had a dream run. But that's fair. I mean, it's not something that you look at playing. Ajay, on financials, since that is a big holding for you, I was looking at the large cap fund as well. I mean, financials form a large chunk of that portfolio and many of your other funds. The market is getting very worried. And the manner in which we've seen financials fall, large companies, banks and non-banks, get pummeled in the last few days, it seems that the macro concern is now beginning to get priced in. Macro concern. And maybe it's, a little bit of panic. Maybe it's some concern on credit quality as well. What if people start defaulting? Corporates start sort of, because of these force majeures, corporates start showing up issues with credit. What did you make of this pressure on financials? And would you add more in this dip? Or, I mean, how are you thinking about it?
I'll break it into two parts. One is growth and second is asset quality, as you spoke about. So in terms of growth, I think 3 6 months back, some of the large, good marquee lenders, they raised some concerns. But now, if you look at their commentary, it is actually they're talking about decent growth. So that reset in asset quality vis-a-vis growth has already happened. Uh, there could be pressures in certain categories of financials. So, for example, if you are a CV lender, now because of increase in prices, say for the time being, the oil prices pass through is not happened. Gas, we are already seeing that happening. But at the end of the day, if this thing continues, I think there is some kind of tolerance band, but beyond that, it has to be passed on. Then it will start impacting the economics. So there are certain lenders which have exposure to those kind of asset classes. They will see pressure in margin. I don't say that asset quality issues will start coming so soon. It takes time. It takes 1 or 2 years of consistent pressure for quality issues to come. Because see, it takes time for them to resolve also. Now we are in that cycle where most of the balance sheets are very clean for corporates. The leverage is very low. So we don't see that immediately there'll be pressure on asset quality. But yeah, consumer facing lenders may start seeing some bit of pressure. But I don't think that will materialize into crystallized losses. Margins is something where there could be some bit of pressure. So I think this will be more of a P&L
Okay.
problem rather than a balance sheet problem.
Okay. So, Ajay, you tell us, what have you been buying in the last 10, 11 days since this war broke out? It is an opportunity, I guess, to get stocks at a much, much better price because everything in this market is falling, right? So, what have you been buying?
See, we spoke during such times right now, market, it's very difficult to, differentiate between what is fundamentally uh, falling and where there is just market, there is lesser interest. That's why stocks are falling. But when we spoke to our strategy team and they compiled some data, so whenever Indian market in last 15 years, they have not given or negative return of, say, within a period of 1.5 year. Next 1.5 year has been fairly good, and the return is between 5 to 20%. Also, see, Jan to March, Indian markets historically has been under pressure. March to December, we do well. So all these things are good. And as of now, we are adding to the stocks which have fallen in our portfolio without any fundamental reasons. But I would say there is lesser interest in market. Small caps clearly are seeing more pressure. Anything below 10,000 crore market has practically fallen 25% or more. So, see, these are the times which we always talk about. We talk about all great investors, how they use opportunity like these, where fundamentally things have not changed, but the prices have corrected. So, I think when the market will come up, it will be a broad-based rally.
Okay, and I think for that we all wait, right? That's the hope. Indian investors have been dealing with underperformance for a long time, and I'm sure everybody is hoping for that turnaround to finally happen and for the bad news to finally end. Ajay, good conversation. Thank you so much for joining in and telling us how you're thinking about this extremely volatile phase and how you're looking at balancing out the portfolios at Motilal Oswal AMC. Have a great Friday, and we'll connect again soon. Thank you.
Thank you.
All right, that's a view from Motilal Oswal AMC. Let's see where the market is at. The market continues to reel under pressure. The Nifty is struggling. It's still below 23,500. The drop is about 180, 190 points in the index. You can see it's fairly choppy. There are buyers coming in at the lower level, but there's constant selling pressure. So the market is not really able to make any sort of a meaningful recovery. And now just flash the Nifty losers. You'll find a lot of metal stocks on the list. Hindalco, Tata Steel, these stocks are falling a lot. 3.5% down on Hindalco. Tata Steel is down 2.5%, 3%. L&T continues to face pressure, as you can see. Almost 3,600 on L&T. Interglobe Aviation, obviously, for obvious reasons, crude oil is very much at $100 a barrel. So these are some of the stocks which are down in today's market action. We will keep getting you more stock action as we go along. But also let's welcome in Matt Orton. Let's get a global voice into this conversation in terms of how the world markets, and of course we here in India, Indian investors, how we are looking at this war, which as of now is showing no signs of ending. Hi, Matt. Thank you so much for staying up for us. Good evening to you, first of all.
Hey, thank you. Good morning, Surabhi.
Matt, who would have thought, and I know we've been speaking, last time we spoke, there was no war. You have remained an India bull. And I remember we were talking about earnings, looking better and a recovery finally coming through. And now here we are, $100 a barrel, oil. What have you made of this war, the developments, the geopolitics around it? And the biggest question is, how long will it last? And I don't think anyone except President Trump has the answer.
Yeah, well, I don't even know if President Trump has the answer with respect to what this duration of the war will be. Because
I didn't say that.
It's not only up to him.
I wanted to say that, Matt. I wanted to say that, but then I was cautious. So, thank you. Go on.
No, but it's a great point because it's no longer just in the U.S. or Israel's hand with respect to how long this is going to go. And I really think, Surabhi, that's what's leading to so much of the uncertainty that we have out there is because Iran has appointed a new supreme leader and now they inject volatility into what it is that we see happening. So with respect to where I stand, and where the markets stand right now, this is not a time to be a hero as an investor. This is a time to manage risk in portfolios and to start building a shopping list of things that you might want to add to your portfolios, whether it's holdings that have gone down that you want to buy because the fundamentals remain very much intact, or names that you don't have exposure to or themes that you may have missed that perhaps look more attractive at today's level. But I've been gradually de-risking my portfolios even before this war. I think just the markets look technically strained. I don't like, at least in the US and in Europe, where you were seeing technology go down at the same time as consumer staples were going up, financials remaining weak. So there were a number of signals beneath the surface. And despite the fact that everybody was talking that there's increased breadth, where you're seeing international work and small caps and mid caps in addition to large, to me, not everything was lining up. And I think that remains the case today until we can see stabilization in the financial sector. At the same time as you see some of the bigger technology names from a global perspective start to hold up better, it's going to be difficult to really wade in with any sort of conviction. So I've been hesitant to add too much to this market. I've been gradually selling things that aren't working and being very conscious with my team about what we're going to buy when we think we're not catching a falling knife anymore.
Yeah, absolutely. Great points, Matt. And before I talk about what you're doing with your India part of the portfolio, just your sense on the other issues. I mean, the war is one issue, but let's not forget, tariffs are still very much an issue. We have no idea at what tariff rate the world is transacting with the US because the Supreme Court struck down the tariffs, and then now we have all these new investigations launched under Section 301. Of course, we're so busy with the war that no one's really discussing it out in the open. And then there is the private credit market in the US with a lot of these issues happening and some of the funds pulling back and stopping redemption. So let's take trade and private credit and let us know whether you think these are also risk factors.
Those are both really good points. And I'll start with the latter one first, which is private credit. And to be honest, I think the private credit issues right now are overstated in the market. I'm actually more optimistic on where private credit stands, the exposure to software, the perhaps overreaction to AI killing all software businesses. And really, at a very high level, the reason why I'm a little bit more optimistic is because the market is assuming default rates, it's assuming a lack of recoveries that are significantly worse than where we were during the GFC. And to me, that is not going to be what happens today. The GFC taught a lot of these companies how to work out of deals, It has taught companies how to be able to recover, or at least be able to get some of these annual recurring revenues to their bottom line without companies going bankrupt. So I think that the worries for private credit are front and center with respect to sentiment, but I don't think the reality meets where sentiment is. So I think there will be an opportunity in financials, but it is not going to be in the near term until we clear that sort of hurdle. So when I'm looking to buy the dips, or the areas in the market that I'm focused on for buying dips, financials are not one of them. As much as I like the fundamental story, I think it's going to take more time to get through private credit because we're distracted by the war. And at the same time, when you look at tariffs, and I'm so glad you brought this up, because we started to talk about these investigations at the same time that this war continues to flare up, I think that is going to be a challenge with the visibility for margins for companies overseas as well as in the US. So I think looking at areas of the market that might be a little bit more insulated from tariff pressures are going to be important. And again, that leads me back to some of these bigger tech winners, some of the secular growth themes like we've talked about before that are impacting companies globally, say defense, increased defense spending in this fracturing geopolitical environment. Those trades still look very, very attractive to me, even though they have performed well so far this year.
Okay, got that important context, and it helps us understand just how you're thinking about these things. So private credit, yes, and it's an issue, but probably never becoming as big as GFC, because that itself was a huge lesson for everybody, hopefully. Matt, okay, now let's talk about India and what you're doing here. First and foremost, and I know you've been an India bull and very patient with this market for so long, but because you're de-risking the portfolio, have you been paring back your positions on India? How much of your portfolio is Indian equities right now? And last time when we spoke, for instance, you were taking off some positions in large banks here like ICICI and HDFC. But at the same time, you thought that Indian IT stocks have been pummeled a bit too much because of this whole AI issue. So you were studying some of them and seeing if there's an opportunity. So just tell us how you are re-jigging your India portfolio.
Yeah, you're exactly right. And so broadly speaking, from an emerging market perspective, I have been pulling back emerging market risk. I think it's challenging with the dollar appreciating, with oil prices moving higher. It's difficult to hold emerging markets in that risk management context. I can only afford to give up so much risk or manage sort of my my standard deviation of the portfolio, and I don't have as much tolerance on the emerging market side from a risk perspective right now. So I broadly sold off emerging markets from portfolios. That includes India. So the weight in my portfolios to India right now is at the lowest it has been in years, which is about 2%. And I still might pare a little bit more risk back, which is unfortunate. But where I still have conviction and where I will be looking to add, I think first and foremost, it's in some of these long-term winners that while they might be impacted by some of the oil prices, I think there's long-term durability to their business, and their customer is going to be able to weather some of those price pressures more. So a name like M&M, we've talked about before, that I think that their more premium customer, I think, is better able to afford oil prices. And I don't think that an increase in fuel prices is going to significantly derail the growth story, especially from the agriculture part of their business that I already thought was undervalued and underappreciated. Similarly, names like Adani Ports, where yes, they have some exposure to the Middle East, but that is not the overall success story for them. It's based on better integrating and capturing wallet share from their customer from start to finish of the transport of goods. That has been paying off in spades. And again, I don't think that changes significantly because goods still have to move. People in India will still be consuming, and I don't think that's going to significantly change the overall outlook. So those are higher quality assets that I still like. I think financials have broadly been oversold. Asset quality looks much better. I think the ROEs these companies are able to post have been consistent, low to mid double digits. Those are compounders that I like a lot, and valuations have come in significantly, really this entire year, but accelerated by this conflict. So that's another area where I think you can start to look for opportunities at the bottom. And finally, on the IT services side, while I think there is an overreaction, very much so, to AI killing all of those businesses, the sentiment has not changed, and it's tough to kind of stick your neck out in front of an oncoming truck. And it's something that I'm not going to do. That's where I might wait to be a little bit late to have confirmation. But monitor earnings, because at the next earnings season, if you see stability to their bookings and to their customer base, that's going to be a positive signal. So I think if you start to get some positive reads at the next earnings season, that might be the time to start waiting in.
Okay, all right. That really explains it very, very clearly, Matt. And it's good context for our viewers to have as well. Just tells us how you're thinking about risk, about just balancing out the portfolio, and gives us a clean vision into what you're doing here in India as well. Well, we hope for all the investors out there, the traders, and for humanity at large that this war comes to an end. The market anyway has enough on its plate to deal with trade and tariffs and private credit and AI and so on and so forth. We can all do with one less war in the world. So fingers crossed. And on that optimistic note, we'll let you go, Matt. Thank you so much once again for staying up for us, and look forward to our next conversation soon.
Have a great weekend. Thank you.
Thank you. You too. Okay, so that's a view coming in from Matt Orton of Raymond James in terms of how they're looking at markets. They're really lowering the risk quotient in their portfolios, pulling back from EMs, reducing exposure to India as well, and changing things around in the portfolio, as he explained. Okay, so let's just dive into the market right now. Dive is probably a bad word, or maybe an apt word. Look at what's happened. 270 points down now. It's just, there's no stopping. The problem in this market is you don't know where the bottom is and where the end to this fall is. It will, at some point it will stop. But we just don't know. We have no visibility of that point, at least as of now. No visibility of what's happening in geopolitics. But, we must remember that whenever there is a breakthrough, there will be a very swift turnaround as well. And that's what markets are all about. We'll reach that point, and then there'll be a sharp short covering rally. There will be a sharp recovery. But for that, we need hard evidence that something, is coming through in this war, and somewhere there's a geopolitical breakthrough or an off-ramp. Well, let's see. We're still waiting in hope. Right now, the indices are down about 1%, and the Bank Nifty, ouch, look at the Bank Nifty, 1.6% lower. Big banks are really, really taking it on the chin, and there is all-round weakness on banking stocks today. So that's the market, that's the Nifty for you, and that's the Bank Nifty. We'll keep flashing more rates, but for the time being, the market is still doing what it is, it's still falling. Let's look at something different, and something which has been a little positive, and something which perhaps from a policy perspective, really sets us on the right track. And I'm talking about the changes that the government recently announced in Press Note 3. That Press Note has been amended. And through these amendments, now the rules that govern the flow of foreign direct investment into India from India's land border sharing neighbors. So our neighbors, geopolitical neighbors, which share a land border with us, obviously it's China, it'll be Nepal. So for them, a couple of rules have been eased. Now, how significant is this? Does it really help? Will it mean more FDI coming into the country? Those are the questions that we are going to put to Moin Lada, who is partner at Khetan and Co. Moin, good morning. Thank you so much for joining us on Moneycontrol. You and I have spoken on CNBC and other platforms, quite often.
That's right.
This is the first one on the digital platform. So welcome to the conversation, first of all.
Thank you so much, Surabhi, for having me.
Okay, so Moin, you know what? We've spent the last so many days only talking about the war and the market. That frankly, I think let's start with the basics. If you could explain to our viewers so they understand what exactly is this policy change? What are these specific amendments that were announced, I think, on Tuesday or Wednesday when it came to Press Note 3?
That's right. So Press Note 3 was, I'll just give one line background. This was notified during COVID to prevent opportunistic buyouts from bordering nations. And what it prescribed is that you needed a government approval. Now, one thing that wasn't really clearly provided was what is the threshold of beneficial ownership in cases when there's an indirect acquisition in India, indirect FDI. People relied on the Companies Act to understand the threshold because the significant beneficial ownership rules do provide 10% as a threshold. There was also a look through to the Prevention of Money Laundering Act. Now this release that has come through, and we are still awaiting the notification on the press note by itself. But the press release has clarified that the beneficial ownership threshold will be 10%. So indirectly, if there is a 10% or less of ownership from bordering nation shareholders, then the press note 3 applicability won't be there. And the second thing that it has provided is that there's a de minimis threshold so far as investments is concerned. So if one is investing just below 10%, then again, one would have a safe harbor so far as the applicability of the press release. So with this, there is clarity now in terms of, this is the first aspect to the amendment. The second part is that there has been fast tracking provided and 60-day period provided.
I think
Getting technology.
I think we've just lost that line with Moin. Moin, sorry, we lost you there. If you could just repeat the part, you're talking about timelines and how the regulatory timelines have been crunched.
Yes.
So if you could just go over that again.
Can you hear me now? Okay. So
yes.
The second part of the amendment is that for certain strategic sectors like electronics, capital goods, solar power, where technology and collaboration is much needed in India, there is a 60-day period provided as a timeline within which this process will be completed. So there's a fast track, because when we started off this process, approvals took as long as 8 to 12 months. So with this 60-day period, fast track for certain industries, there will be much needed clarity and less uncertainty on this transaction.
Okay. So Moin, I think this largely goes back to the China question, right? And for obvious security reasons and the conflict that had broken out in 2020, I think all the rules were tightened. Now, the amendments and this change in the definition of beneficial owner, I think it's been now aligned with the PMLA definition. To what extent does this open the door for Chinese investment, more joint ventures?
Okay. So I think, Chinese investments have, in terms of the total FDI in India, historically, the total Chinese investments have not been a very large portion of the total FDI. So I think it's more about a selective partnership than a flood of capital that we should expect, and we need to be realistic. So far as technology and collaboration, I would say that, yes, there will be a lot of deals which were otherwise on a stalemate position. They will start moving ahead. But one of the conditions we should be mindful of is that the control at all times has to be maintained with the Indian party and the Indian shareholders. With this condition being there, how much of cutting edge technology and collaboration will happen from China is something that we'll have to wait and watch. Because how much of commercial feasibility in a non-controlled structure would they be open to sharing?
So, under the automatic route, only 10% investment is allowed. Obviously non-controlling, and the cap is 10%. Isn't that too low to really bring meaningful partners, at least under the automatic route?
That is correct, Surabhi, and I think that 10% is to address two things in my view. We are seeing a lot of reverse flips into India after the fast track of, offshore mergers. So when we are doing these reverse flips, there are chances where there will be some beneficial owner sitting there or some small Chinese investor or limited exposure already there. So those will be eased with that definition of beneficial ownership. Less than 10% is more financial investment. You're right, as you rightly put, it's not really a strategic joint venture because we wouldn't have a technology joint venture with one person just holding less than 10% or one of the investors holding less than 10%. So that threshold is low. So the intent really is to allow financial investment, but have guardrails in place and approval required, probably fast track if you're doing a larger investment in the company.
Okay. And Moin, this is largely for FDI, right? Does it in any way impact portfolio flows, FPI, coming from our land neighbors?
So Press Note 3 by itself was applicable and continues to be applicable only for foreign direct investment. A foreign portfolio investment is a separate route of investment, which has its own conditions, and that's not really impacted by this amendment or the press note by itself.
Okay, got that. So, Moin, to wrap up, what are the implications, and in which sectors, if at all, do you see joint ventures moving, or strategic capital moving, or will it be largely financial capital like we discussed?
So strategic capital will move so far as certain capital good industries are concerned, with an approval, obviously, because those are fast-tracked and there's much more certainty. Because even India as a market is an opportunity for anyone who's bringing in new technology. But to sum it up, really, if we look at the whole architecture of this policy, it's not opening the door to Chinese control. It's about allowing capital and technology while ring-fencing strategic influence with the Indian person and enabling financial investment, private equity investments, reverse flip structures, where incidentally, due to minimal exposure of Chinese LPs, transactions were not being able to be proceeded with. Another thing I just want to add, Surabhi, is that one more problem I've seen in our transactions is where listed companies invested into India and beneficial ownership was so dynamic, with smaller Chinese exposure that will really not get impacted now after this gets notified as law mentioned.
Okay. All right, Moin, thank you very much for joining in and explaining this to us, the amendments themselves, and what they potentially could mean for more joint ventures and more capital flowing from India's land border neighbors. Very, very helpful. Thank you for joining in. You have a great day, and we look forward to more conversations in the future.
Thank you very much.
Thank you. All right. Well, with that, it's almost time to call it a day on the show, at least on opening bell for now. 277 points down on the Nifty. The midcap index is down 1.6%. The bank Nifty is down 1.6%. It is yet again a tough morning of trade. In fact, let me just do a very quick check. How much have we fallen this week? I'm just looking at the Nifty tally for the week. The Nifty is down 4.5% this week. It's been brutal and it's continuing. Nifty Bank is down 6% this week, this index. It's fallen more than the Nifty. Tough market. Well, we continue to watch geopolitics. It's all about the posts, the tweets, the statements, and the sound bites that are coming in, with the market hoping of some resolution, at least on the Strait of Hormuz, some flow of tankers. But as of now, we don't have any of that evidence. In fact, tensions in the Middle East are escalating quite sharply. Iran's new Supreme Leader, Mojtaba Khamenei, in his first remarks since succeeding his slain father, vowed revenge against Iran's enemies and warned of closing the Strait of Hormuz and striking US bases. Meanwhile, Israeli Prime Minister Benjamin Netanyahu issued a strong warning, even hinting at targeting Iran's leadership while calling for the Iranian people to rise against the regime. As both sides continue exchanging strikes, listen in to these soundbites. Thank you for watching.
There must be an effective presence on the scene, including the enemy-breaking presence at the Quds Day rally, which should be noticed by everyone. Certainly, the leverage of blocking the Strait of Hormuz must continue to be used, and opening other fronts where the enemy is highly vulnerable, if the war continues, will be considered while observing strategic interests. As we had given an explicit warning, and without carrying out any aggression against those regional countries, we remain committed to the necessity of friendship between ourselves and those neighbors, and have merely targeted those U.S. bases. From now on, we will also be compelled to continue this action. We will not refrain from avenging the blood of your martyrs, especially the crimes against children, such as the deliberate crime at the Menab school. I also sincerely thank the fighters of the Resistance Front. We consider the countries of the Resistance Front as our best friends. The cause of resistance and the Resistance Front is an inseparable part of the values of the Islamic Revolution.
Even now it can be said with certainty, this is no longer the same Iran, this is no longer the same Middle East, and this is also not the same Israel. We are not waiting, we are initiating, we are attacking, and we are doing so with a force the like of which has not been seen before. I have added another goal, to create the conditions for the Iranian people to overthrow this terrible tyrannical regime. To create conditions doesn't guarantee that it will happen, and I told them just now, in what I said a moment ago. I said,
it's up to you.
It depends on you. I wouldn't issue life insurance policies on any of the leaders of the terrorist organizations. This is their patron of terrorism, and I don't intend to provide an exact report here about what we are planning or what we are going to do.